to our session with Industrial Alliance. My name is Olyana Grod, and I am a business development executive working out of the Mississauga office in Ontario. I'm joined today by Venora and Rishu. They are based actually in British Columbia, so they are a couple hours ahead of us if you're in Ontario. The topic today is going to be on life insurance as an asset class. So we have Venora on the advanced case side that's going to touch on that. And then we have Rishu, who is a life sales director that will also continue on in the presentation today. So Venora is going to kick things off. She cannot stay for the duration of the webinar, so she's going to pause at the end of her section to take any questions, and then Rishu will continue. For those of you joining us today, this is CE accredited. We're pending in Alberta, and this is not accredited in Quebec, but for all the other provinces, you will receive a CE credit after today's session. So not to hold things up too much, I will pass it off to Venora. We are recording this, so this will be available on the IDC WIN Big website in about 2 weeks' time. And please do feel free to use the Q&A to drop a question, but we will also open it up to some questions as we move on. So thank you, Venora and Rishu, and I leave it to you.
Awesome. Thank you. I think I need you on every one of my webinars. So you can do my introduction and housekeeping and everything. And that was perfect.
Deal.
Okay. Just going to go ahead and share my screen, make sure that everything's working properly here. Give me one moment. Good morning and or good afternoon, depending on where you're connecting with us today. My name is Venora McClay. I am from IA Financial Group. I'm joined here today also by Rishu Baines, one of our life directors in BC. And we have a topic for you today that is called life insurance as an asset class. And it's really just taking a look at a way of positioning life insurance for a business owner, another way to have that conversation and to kind of introduce the benefits of having corporate health insurance. So it's a conversation that I think is really valuable if you're looking for a new way to get into that market, or it's new for you entirely. The goal will also be to kind of showcase some of the tools that we have available at IA to support this conversation. So Rishu is also going to connect on the end on a couple of the newer changes that we have at IA that can help support advisors, but really together as a package. We want you to be feeling like you have all the support and tools you need to work with your business clients on the life insurance side. At the end of the day, that's the goal. As mentioned, there are going to be some times for questions as we go, and I hope that does fulfill anything that you need as we go along. For those of you who have not yet met me, again, my name is Venora McClay. I'm the Advanced Case Director in BC. I have been with IA since 2009, so about 15 years. Always on the sales team working. I've done living benefits and life, a little bit of investment, so I've done a little bit of everything. And I have my CFP and my life license. So I've done all of those things while working in IA. Always connecting with advisors and trying to support them with the questions they have. So my goal really is to provide you with any other perspective or tools that we have with IA to be able to help you work the coverage or work the concept that you're working on with the client. So what we're going to start with first is the obviously first, what is life insurance as an asset class? What do I actually mean by that? And who is it for? So those kind of things are going to go together. And then we'll look at the actual benefits of having corporately held life insurance along with the tools that we have, including the custom illustrations that you can walk through the case with the client or the accountant or lawyer to be able to put this all together for the client at the end of the day. So it's really just to give you a big picture look and a couple of case studies. To begin with, concepts that usually come to me, or the cases that usually come to me, involve taking a look at what that client already has. Maybe they have a small company, maybe they have a commercial property that's a commercial rental property that they have for the company. They have other assets within the company, and they're trying to figure out how can we deal with perhaps estate planning solutions, or can we make things a little bit more efficient on the tax side? Those are usually the two main things. How do we plan for taxes at death, but taxes also today? So there's usually a list of questions that we'll go through, but one of them is, what do they have right now in the company that's not working as efficiently as it could? And that could mean that the client has some assets that are sitting there doing nothing. For Canadian small businesses, we want to keep their passive assets under that 500,000 threshold. And sometimes there are companies or clients, they don't realize that that threshold is important for them to have the small business deduction. Maybe, and I've come across this often, the accountant is making sure that they're fine, doing processes in the background, but the client isn't really, let's say, as aware to what's happening, or maybe hasn't been able to take the time and look at how can we do things a little more efficiently. So really at the end of the day, what we're trying to do is take a look at the assets the client has, the goals that they have, but also see if we can move a little bit of money that's over here, doing maybe not a lot, put it over here into something that's a little bit more efficient. We're just reallocating money or repurposing it, putting it from one place to another. And that's it. And we're just going through the benefits of doing that at the end of the day. So the next slide that I'm going to have here is really taking a look at that concept. Perhaps, let's assume the client has some funds. Maybe they have mutual funds that they've put a little bit of money away because they have some money stuck in the company. They don't want it to sit and do nothing. So they've put it in some funds. And let's say in this case, the example is a mutual fund with a little bit of equities and a little bit of fixed income. They're going to get some savings over time. Every year, that amount will grow and grow, but there's going to be tax charged on those amounts every year. And one of the benefits is they could always access that capital if they need to. They can pull money out of that mutual fund and use it for whatever they need to within the company. Perhaps they are investing in some new equipment, or maybe they're purchasing a new location, for example, if they're expanding. There's lots of different reasons why they might want to access this capital. But there is a downside. When you access that capital, if you're selling those mutual funds, number one, it might not be the best timing to do it. Perhaps it's a down market, not an up market. They might not be at the best advantage at that point in time. But additionally, there's also capital gains tax and a tax on the dividend to the estate if we're looking at a sale on death. So there are some inefficiencies that are inherent in this structure that we could do a little bit better if we want to make it a little bit more streamlined for the client, I guess would be the word. At the end of the day, the little bar on the right, the bar pie chart on the right is what we want to make a little bit more efficient. That gray section is the amount that goes to CRA. What we want to do is make that gray section a little bit smaller, or as small as possible, so that we can retain as much funds within the company that is their own, or make plans more efficient for succession planning or estate planning at the end of the day. So moving on. Now we're going to introduce the opportunity to have a different portfolio. Overall, we're looking at something that's still going to have the opportunity to have investments, but also life insurance at the same time. So we're just adding one more layer. We're still going to be able to have equities and fixed income, but now we have life insurance attached to it. And we will have had to go through a little bit of a needs analysis to figure out what that value will look like, how much life insurance the client actually has. But let's take a look at the overall general benefits that they will now be adding to their portfolio. They're still going to have the opportunity to have that savings potential. They're still investing their money into the market. There would be tax on growth, except if they're putting it into an insurance portfolio, there's going to be tax-free growth every year. So we're actually sheltering that money and letting it grow at a little bit faster pace. You're not paying tax on it every year. You're allowing it to grow in a tax-sheltered environment, which is always going to be a benefit. And additionally, the death benefit when the person passes away is going to have a tax-free amount. So there's going to be some big benefits right off the bat in terms of the numbers and how things accumulate just based on the tax sheltered piece. You still will always have the opportunity to access that capital in multiple ways, depending on the type of coverage that's chosen. You could withdraw the funds potentially with tax. We'd have to look at what that looked like for that particular case, and we can illustrate that and run scenarios and look at pros and cons. Or you could look at doing a policy loan or a collateral loan. And a lot of times clients maybe will put something like this into a place and not really have the intention of loaning against that value, but something could come up in the future and there's this great opportunity to invest in this project over here. I really want to do it. Can I access some of the capital in my policy to do so? Absolutely. And we can help facilitate that on our end as well to show some projections of what they have available, what the lending side might look like, etc. So there's really still the ability to access that capital for the client. We're just giving them something that's a little bit more flexible in terms of tax sheltering. Lastly, at death, if I was to just sell my mutual fund at death, which is essentially what happens, there's a taxable dividend to the estate. A larger amount, of capital gains tax is triggered at that point. Whereas with a life insurance policy, the vast majority of that capital that comes into the company through the death benefit will be able to flow through the CDA tax-free. There is a potential, if there's a ACB we need to look at, that some of it will be a taxable dividend, but for the most part, you're going to have a large amount that comes out tax-free from the company that can facilitate whatever estate planning or succession planning solution we've been trying to put together. So you really do get a more efficient tool because you have the tax sheltering initially for every year as things grow, but you also get that big benefit on death through the CDA account. At the end of the day, we're looking at a much smaller amount of money that goes to CRA, which makes it much more efficient. So this is one way to have a conversation of just using a different tool, perhaps investing the same amount of money that the client is already investing every month or every year into another investment. We're just adjusting the tool to make it more efficient for the client. So who is life insurance as an asset strategy for? And there's a couple of key things that I would recommend taking a look at before you put this into place. Number one, we're talking about a business owner. Theoretically, I guess this concept could really apply to an individual as well, but right now we're looking at business owners because we're also looking at the CDA account and the benefit of that. The individuals also have to have an insurance need. If they already have enough insurance, or we're looking at purchasing an amount that is not really that realistic, it might not really get through underwriting. If we're looking at multiple millions of face amount, but they only actually need a couple. We just have to make sure that we're looking at the needs of the client first, based on the needs analysis that we've done for them. Number two, a fairly consistent access to capital is required. So we need to be able to fund the policy. It will be more beneficial if we can shelter more money over time. So having the ability to make sure that they're going to meet the minimum requirement to premium to keep the policy going, but also if they have the potential to overfund it, it's going to be better for them to have a greater value to lend against and to shelter over time. So access to income or assets that are not being used right now. I have seen cases where a business owner has the intention of expanding in the next 3 to 5 years, for example. They have capital that's sitting there doing nothing right now, but they want it to grow and they have that important intention on expansion in the future. So what we would do in that case is really look at what value do they need in that 3 or 5 year time frame, and what life insurance amount are we working with? Can we kind of fulfill that need or that commitment with lending against it in the future? And we can usually kind of work something out to hit those targets. And it really does help support some certainty for the client being able to do that expansion that they're planning on. The money is there, They know it's going to be available, but it's also growing at the same time with much more certainty and tax sheltered benefits. So we could do all that. We just need to know the goals. Pardon me. Predictable cash flows. This can be important depending on the product you're looking at for the life insurance side. It may be more necessary depending on one product over the others. Every product has a little more flexibility, but really being able to know that company or the business owner is going to have X amount of dollars every year to be able to put into this strategy is really going to make it ring true, I guess is the way to say it. A couple of objectives of the strategy. So the main goal is, number one, protection in the event of death. We're putting together corporate life insurance. The corporation has the funds to do whatever it is they're doing for estate planning or succession planning based on the life insurance we're putting in place. We're able to also add some diversification to the overall client portfolio. Remember in the very beginning, I have the slide up with all the other assets that might be within the company. They might have cash, they might have inventory, they might have other securities, perhaps. Maybe they have real estate, whatever it is. This is just another way of adding another layer of something that's going to diversify their portfolio. We'll get into that in a little bit more detail in a moment. Tax efficiency, there are a couple of different layers, and we're going to go into those in a couple of moments. Tax sheltered growth, non-taxable death benefit, and the CDA account. All of those things are direct benefits of putting this together. And then lastly, access to liquidity through either a policy loan or a collateral loan. And some products will facilitate this a little bit better than others. So it's worth taking a look at that also. So in the event of the individual passing away, before they've retired, really the goal is to take care of that estate planning need or succession planning need. That gives the company the opportunity to use that cash value to either repurchase shares from the estate or allow shareholders to purchase from the other individual if there are multiple shareholders. There are multiple concepts we could work with. At the end of the day, really what we're doing is providing the accessible cash at that time for the company to continue on, or succession planning based on the client's needs. It also will, or the strategy also will, provide some really attractive internal rates of return if you wanted to run that and look at the overall out of pocket compared to the overall amount that the client gets back. At the end of the day, we can run those numbers, and most often this is a very attractive strategy to put together. Next, we have diversification. I'm going to focus primarily on our PAR product that we have available at IA, and Rishu might mention something about it. But really, the goal here is to use a tool that has the most access and flexibility for lending against the internal values. And so that on our end would be the permanent PAR coverage. We will be looking at that. And with our PAR product, we do have some alternative assets that are within that actual fund. If you're not familiar, alternative assets or alternative investments are usually reserved for clients who are accredited investors. So feels like a lifetime ago, but before I worked with IA, I was actually working with an IROC firm on the compliance side. And at that time, I was part of also looking at the documentation and approvals for accredited investors. And at this, I believe you have to have a $250,000 income rather is one of the qualification levels for an individual to be qualified. There are other criteria as well, but just to give you a picture, some of the assets that are in the PAR fund are typically only available to those clients, those more wealthy or affluent clients. This PAR fund therefore gives the everyday individual like myself or yourself potentially the ability to access some of those assets that they might not be able to access otherwise. So they do provide attractive returns with a moderate amount of risk. And they're not usually things that we would see in a regular traditional fund. So it's a part of the par fund that is designed to give a little bit of an extra boost to the overall returns. So what is an alternative investment? It is not something that is one of the normal things you'll see in the fund, like a stock, a bond, or cash. It could be something like real estate. It could be derivative contracts. It could be part of hedge funds or private equity. We do have some of those pieces within the par fund. And here we go. This is as of September of last year. It gives you an idea of our private equity down here. We had 17% of private equity. Real estate was about 11% of the fund, which will provide, private debt also, 15%. So there is an amount of alternative assets within the par fund that is providing a good, strong return that would not be otherwise accessible to the regular everyday individual. So just in terms of choosing the asset that we're putting money into, it's going to be something that's profitable for the client and allow them to tap into something that they might not already have. Okay, next we're moving on to tax efficiency. This is the first one, is every year the growth that's growing within the policy, the life insurance policy is growing tax-free. So you're not getting dinged on that every single year. There's not a payment required. And then the death benefit is not taxable to the beneficiary, whoever that may be, whether that's the company, a shareholder, the estate, depending on the structure that you're working on. The amount that can flow through the CDA, for example, if we are flowing the value out to the estate or another shareholder, the CDA amount is always going to be the death benefit minus the ACB. And this doesn't have to be difficult. This is actually something that's easily projected or provided in the custom illustrations that we have. And we're going to go through that in some detail. We can also run some illustrations to take a look at product A, product B, product C, which one gets me the highest CDA amount at age 85, for example. And we could take a look at that and help walk through the pros and cons of different coverage options. The corporation may be the beneficiary of the face amount, and they would receive the tax-free dividends, and who could then share that to shareholders or the estate. So at the end of the day, there are a couple different ways that we can structure this, but we're using that capital dividend account to work with this. A couple of things, some highlights that we need to keep in mind. To have access to the capital dividend account, it has to be a private company. It can't be a stock company. It has to be a Canadian company as well. The individuals do have to all be, the owners do have to all be Canadian individuals. It is not an account or a dollar amount that you can find on any of the financial statements. It's just an account that's used for tracking purposes from CRA. If the client wanted to find out what that amount is or what they have available, they would actually have to call CRA or connect with CRA and figure out what their balance is at that time. If you do want a little bit of more information in terms of how that CDA account is calculated or what is eligible, we do have a document that I have the link to right here. So you should, I believe, get a copy of this presentation. And I will also have a QR code to the website also in a few minutes. But you can go to our Large Case Solutions website. You just have to Google search Large Case Solutions IA, and you will get there. It's the top link that comes up. But there's a document on that website that looks at the CDA calculation, what is and what isn't included, and how it's included, and how the math is done. So I do find it helpful to just have an understanding in the background of how it does work. That is a tool that we have available. Sometimes it's useful. I have had some advisors use it as a useful tool to connect with the client's accountant and walk through this strategy and highlight where the life insurance falls into play and how this can be beneficial. So that's a resource available for you. Continuing on a little bit more in terms of the tax efficiency, when we are using company dollars to purchase the life insurance policy or the face amount for the individual. Perhaps it's a key person or shareholder. We're using company dollars, which is taxed a little bit more efficiently than potentially the personal individual dollars. So we're using premiums paid with after-tax company dollars, which can be better. And they're taxed at a lower rate, and it makes it overall less expensive to do. Corporate-owned life insurance is not subject to the passive income rules. As part of the reason why we can do this, we can have an investment-like tool, that life insurance tool within the company, because life insurance does not impact that small business rule, which is great. Access to liquidity, we've brushed on this already. There are 3 ways that we would suggest accessing some of the cash value in the policy. Number 1, policy loan will always be available. It's part of the contract. If the client's financial situation has changed at some point and they're maybe not eligible for lending, that policy loan feature is always available, as I mentioned, contractually an option. It may not be the best lending rate at the time for the client. It really will kind of depend on the situation and the year and the market that we're having. The other 2 options are potentially a partial surrender of that cash value. It may impact the life insurance coverage at the end of the day, but it is accessible for sure. And then lastly, collateral loan. There are multiple lenders that we can work with who will loan against the value in the par policy. So it could be the client's bank that they already have a relationship with, or it could be another external lender that we can work with. If we are planning on doing lending with this client, as I mentioned, there is the option to do a custom illustration. So we can actually illustrate at a certain year. We're projecting on lending this value out at year 7 for an equipment purchase, for example. What is that going to look like, and how is that going to impact the CDA at death? So we can actually project that and take a look at what that will really look like for the client. The other thing to keep in mind also is potential tax consequences of each option. We do need to have that kind of in the back of our head. Is this going to be an impact for the client at that time? And we can, again, project those values and take a look. Okay. Doing a collateral loan, as I mentioned, there are multiple institutions that will lend against our par policy, and we already have those relationships with them. The borrower can use the contract, their life insurance policy, to lend against, take that value, and then invest into another asset. Whether it's for personal or company use is another question, and there are pros and cons with that as well. The point here is that it is a value or an asset that is available. Anytime we're looking at lending against that value, typically we're looking at either an IFA or an IRS, which is IFA, immediate financing arrangement, IRS, insured retirement strategy. You may have heard those before. Really, they're just lending strategies with differences in timing of when you lend the values. At the end of the day, we always have to start with that insurance policy first. What is the value there? What are the pros and cons with accessing lending? And will it make sense for that client? And we can take a look at that. A couple of other things to keep in mind. If you were to not purchase the life insurance and you just had the mutual fund investment growing every year, keep in mind the tax rate on investment income for a company is 50%. The tax rate for investments within the life insurance policy are tax sheltered. Right away, you're giving the client a big benefit by putting some of those dollars that they're investing anyways in something that's being taxed every year into something sheltered. You're giving a huge benefit. The other ones are, number 1, you're able to give them something to work with for estate planning or succession planning. You're diversifying their portfolio with access to other investments that they might not have access to. Tax sheltered growth, the non-taxable death benefit, and the CDA are all big pluses for putting this strategy together. And the client always has a backup plan. They always have access to that capital if they need it. And many times, when this is put together really well, the intention is to access that capital and do something with it because they're growing it for a reason and they want to access that for something in the future. So now we're going to jump into a quick case study. I think we'll have 2 case studies today. And I just want to highlight with these case studies, number 1, the concept really quickly, but number 2, the tools that we have available to support this kind of conversation, whether it's with just the client or the client and their accountant or lawyer. Case study number 1, we have a corporate owned policy. We're going to assume that the client is putting in every year $100,000 into the policy for 10 years. Again, I mentioned that it's important that they have the cash flow to put this in. I'm just trying to highlight some interesting numbers for this specific case. So now we have a male, 50 years, non-smoker. Now this is just taking a look at age 85. Let's assume their total investment over the 10 years, not assume, it is, we did the math. Their total investment over that 10-year time is $1 million. If the client decided that they wanted to put that same dollar amount into just fixed income, for example, they would have grown that amount after taxes are taken off to 927. After you take the taxes off the top, a fixed income, remember it's in a company 50% taxation, it's going to be maybe not the best suggestion. If you were to put it in a traditional investment, perhaps something like a mutual fund with a 60% equities, 40% income, you're going to grow the value, yes, but it's still going to have a significant amount of tax taken off the top. What if we did 100% equity? Maybe it was 100% equity or stocks. Pardon me. Yes, they're growing it, but there's a big chunk of the overall asset that's going to be taxed at the end of the day. If we put it into a life insurance benefit, we're able to grow that amount significantly and have the benefits of tax sheltering and the CDA account, making it so that at the end of the day, that $1 million investment turns into $4 million that can be flown through the CDA into the client's estate or to the hands of shareholders to repurchase shares. There's a small amount based on the ACB, the death benefit in the ACB. There's a small amount that could be taxable through a taxable dividend to whoever at the end of the day. We would be able to project those values. But really the highlight here is that we're able to give a far more tax efficient solution for the client in the overall time frame with a lot of the similar benefits that they are already looking for in terms of growing their money over time. Now we're going to do a second case study, and this is going to do something very similar, but we're going to highlight some of the tools that we have, and I'll go through this in a little more detail. This is actually a case that I was working on earlier this year. There's a client who is doing $50,000 of annual premium for 10 years time, a 45-year-old male, he's non-smoker. And this is the first slide of the client concept presentation that we'll have. So it's looking at the concept for life insurance as an asset class. You've already seen this slide. We've gone through it already. It's looking at perhaps what their money is already doing in a fund, for example. Sorry, the lights just turned off. In a fund, for a mutual fund, it is definitely getting some growth over time, but every year there's taxes and there's a little bit of inefficiency for the client at the end of the day. This is the second side that we started with in the beginning, where we're now adding life insurance to that client's portfolio. We're able to use the benefits down here on the bottom, the taxation benefits like tax sheltering, the ability to still access capital, and the ability to use that CDA account and tax-free death benefit. At the end of the day, we're making the amount for the client that has to go to CRA much smaller. Next, we're going to get into a little bit of kind of a flow chart. I found these flow charts to be really, really helpful when you're trying to explain how you're trying to do what you're trying to do with a client. Some accountants have loved this because it takes it from being just columns with numbers into something that's a process, and you can actually track the values as we go. So we start with the company and the individual insured. The company owns that life insurance policy on the individual insured. There is tax-free capital that goes to the company itself at death minus the ACV. There could be a taxable dividend for a little piece of it that goes to the estate, but the majority of the value that the company gets through the will go through the CDA, come out to the estate through tax-free dividends. So that's the flow chart. This is just a conceptual piece. What we're going to do next is illustrate that with the actual numbers that we're working with. So as soon as I have, or the sales director that you're working with, in whatever region you're working with, as soon as they have an illustration based on the concept you're trying to work on, they can request this concept piece for you. So what I have now is I have a death benefit of $799,000 based on my 10 years of $50,000 annual premiums. I know that age 85, based on our projections, there will be a death benefit of 2.9 million. And in this case, it actually worked out that at that time, the ACV is 0. So in this case, that full 2.9 million can go through the CDA into the hands of the estate. In my opinion, having the numbers and the flow chart put together like this is far more easy to understand for a client who just needs the quick concept, this is what we're doing and why we're doing it, rather than seeing columns and columns and columns of numbers. I really like this flow chart. We've had a lot of good feedback based on it in terms of how to sell that and how to walk through the scenario with the client. The table on the right really just gives you something similar. We can adjust these amounts for different years. If you want to look at this happening at age 90, for example, and highlight that, we can do that. It gives you what the net return at the end of the day is for the estate, gross return on investment, and then that projected death benefit. So you can really compare this to other strategies that the clients are working on. This is another slide that's within the concept piece. I'm not going to spend too much time on it right now, but it is an option if you're looking at using par wealth or par estate as an option. And it kind of walks through what is inside the par fund and how it works at the end of the day and what they can do with their paid up additions. In this case, we're just growing that cash value and death benefit over time. This is a slide that looks at comparing to other types of investments. So in the beginning, we started with comparing to a mutual fund. And in this case, we can change these assumptions, but I put on the fixed income, our gross return is 3.2, and on equity, gross return is 6.2. Now we're adding a little bit to the overall portfolio. We're still going to have access to fixed income, still going to have access to equity for the money that the client has. We're just using a little bit of it for life insurance, which is giving us the ability to do that tax sheltering and have the CDA account access. And now you can see the difference between what they're going to get. They're still going to get a similar, a beneficial amount in terms of their overall return. They're still going to come out ahead. But when you look at it this way with the dollars that they're putting in and what they get at the end of the day, it still comes out way ahead. So this is a repetition of a slide that we had earlier. This is just doing it in a little bit of a different way. This is the slide that you would get in the custom client presentation. So here we're saying the client has invested over the 10 years time, the $500,000. They could put it into fixed income and it would earn 1.2 by age 85. They could put it into a traditional investment, like a 60-40 split, 60% equities, 40% income, and it would get about 1.9 million. Or they can put it in equities and it would get about 2.7. If we put it into something like our par wealth product, that's what we're illustrating here, we're going to have a death benefit amount of 2.9 million. So it's really easy to see the value for money in this way. The next step is to now take the tax off the top. Each of these assets in the company is going to be taxed with company rates. And you can see it really takes a chunk out of what's available when you're trying to take it out of the company and into the hands of shareholders to facilitate whatever they're trying to do or have it within the company. It's sold at that time, this tax is triggered, and you can see the clear winner at the end of the day is that insurance death benefit going through the CDA. In this case, our ACB was 0, so there is not a portion that is a taxable dividend at the end of the day. So really, we're just taking the conversation and working it into moving money from one spot to another spot and showing the benefits of doing that, which are really easy to see with these tools that we have available. Again, we're looking at a traditional investment here, some returns over time. The net worth in the hands of the estate is 886 if we're using a mutual fund style investment, compared to using our par wealth over here, where we have that 2.9 million that is available to go to the hands of the estate at the end of the day. So it really does allow for the ability to have a conversation about structuring life insurance within the policy, life insurance within the company as a policy that is now a new tool to give tax sheltering and CDA benefits with all the other accessibility benefits that a mutual fund would also have. Keep in mind, you still need to have that need for insurance first. They have to have that needs analysis done, and we need to have a reasonable face amount that they're working with. They have to be eligible for insurance. If they're not eligible for insurance, this is not going to work. We have to figure out some other suggestions or tools, but those two are definitely must-haves for this to work. Predictable cash flow is important. It doesn't have to be huge, but it does have to be there and available. It will not really work as well if the client really wants to do it, but you know what, next year and the year after that and the year after that, we don't know. It does have to be fairly predictable because you can put something together that's going to be meaningful for the client. Keep in mind, some insurance products are going to be a little more flexible over time than others. There are some features available in terms of our ADO where you can kind of stop and start. So that really does make it a little bit more accessible, especially if things come up, which they always do, one way or another in life. So there really is a way to kind of manage flexibility for the client in that sense here too. There are multiple benefits to the strategy. You have tax efficiency, as I mentioned, with the sheltering and the CDA. You have access to the capital over time if the client needs to use the money for something else, and you're diversifying that client's overall portfolio. Remember, at the end of the day, they are running their business. They have their eye on the target of trying to build that business. They're not really maybe looking at how do I keep everything inside as efficient as possible. That's your goal, and your kind of thing you can bring to the table is how can we make this a little bit better, work for you in a better way. So take that client's overall assets, make it a little bit more adjusted and more efficient. At the end of the day, it will work out better for the client. Quickly, there are a couple of other tools that we do have available. I did mention we can do a plan comparison. So if you're looking at doing something like this strategy with your client and you're trying to decide between one company's life insurance option and another company's life insurance option, and you want to see which one's going to have a good fit, we can run that. If you're trying to decide strategy 1 with 10,000 annual premium for 7 years, and strategy 2 with 10,000, I don't know, 8,000 for 12 years, like you want to kind of figure out what's going to be the best kind of situation and structure, we can run those too. So there's a lot of things that we can do. Reach out to your sales director on the IA side. They're going to be your best guide to be able to point you in the right direction in terms of next steps. They all will have access to someone like myself in this same role in the advanced case team, and we can put things together for you, look at the goals for the client, and sort of put something together that's meaningful and answer any questions that are required. Our teams can sit down and have a chat also with the client's accountant or their lawyer if they need a little bit of clarification. We can always do that as well. I will have in a moment a slide that gives you the link to our website, but if you are not feeling like looking for the link or Google searching, you could pick up your phone and not take the picture, but use the QR code that we have on this slide. This will take you right to our advanced case website, where you will find some tools that include the document on the CDA account, how it works, some guides on how to structure corporate insurance and things to think about. A lot of those materials will be available there. So if you can use that QR code, please go ahead. Or you can use this link at the top. As I mentioned, your first point of call is going to be your regional sales director on the life side. They are going to point you in the right direction on what you need to do to move to the next step. Your regional large case sales director will be able to put together the concept piece for you, maybe answer some questions. And if we need to get into more detail in terms of perhaps structure, maybe you have a holdco and an opco and you're trying to figure out if it makes sense to put it in one place or another, or you have multiple shareholders and other things going on. That's where our large case team can step in. We do have some tax lawyers and tax accountants on the team, and they would meet with us and kind of go through the case, ask questions, and provide some additional guidance on what we can do on that end. So we do have a great team available to you across the country. Again, your first person to connect with will be your regional sales director. If you want to connect to our large case website, there's some great resources on there. I think as the months go on, you're also going to see more and more tools added. We're really ramping up on what we have available to support you, the advisors. So that's really it that I had on my end. I will leave that QR code up for anybody who wants it, but we have a couple minutes for questions, and then I'm going to pass it on to Rishu Bains.
Benora, what I did do was the 2 questions that are there, I just sent you privately in the chat towards yourself, so you can look at those while I go ahead and share my screen, my presentation, and answer those.
Thank you, Rishu. Okay, so somebody has a question about comparing a whole life product with a mutual fund product and a seg fund product. Very good question. So we do actually have a tool that we could take a look at all of those three options if you wanted to compare investing in a seg fund to doing something like what we're talking about today with life insurance. And we could walk through the pros and cons of doing it corporately. We do have some of those tools available. If you have a specific case you want to look at, connect with your regional sales director and they can run those projections for you. We can work with those pros and cons for sure. The last question we have, can you touch on how the ACB changes over years and thereby affecting the CDA balance? Question. Okay, 2 questions. So, I didn't see the last part of that. The first part of that was the ACB and how it impacts the death benefit over time. So the longer the period of time you have for the policy to live, if you will, the longer the period of time it goes, the more the ACP will go down every year. Especially if you're putting in money for a short period of time. If we're just doing for the first 10 years, for example, there's a higher ACP at that time, and then it goes down every year. So for cases where the client is younger and we're putting something together like this, you'll see a little bit of a better or higher amount available for the CDA just because of the time that the policy lasts for. I didn't get what the second part of that question was. There was another, hold on, I think you can go back here. Okay, so how does the rate of return for the power plan compare? I'm going to say it's strong. Our rate is at 6.25 currently. It's projected to be pretty stable and strong over time. I don't know if Rishu is going to add more on that in the coming slides, so I'm going to leave that for her. It's pretty competitive is going to be what I'm going to leave with that on that end. All right, so that's all from me. Please feel free again to reach out to your regional sales director like Rishu. She's going to finish it off. I appreciate your time and thanks for attending and have a great rest of your day from me.
Perfect. Thank you so much, Benora. Again, welcome everyone. Thank you so much for taking the time out to join us today. We really wanted to kind of showcase to you really the strength of IA. We've gone through a tremendous change in the last 3.5 years in terms of corporation and really stepping into the corporate side of things and bringing on products such as our IA Whole Life has really catapulted us into that business owner conversation. One of the main gains from that has been creating our advanced case team to be able to really enhance the conversations that you are having with your corporate clients. Now, Benora went over a great portion of the conversation in terms of really utilizing our Power Whole Life as that alternative asset class and really enhancing the conversation with your clients. What I want to do today is pivot in terms of the changes that we've been able to do. As I mentioned earlier, IA has gone through quite a bit of a change in terms of the carrier, the product changes, software changes, and all of that. So I want to take the last 10 minutes in terms of to really showcase to you a few major changes that we've been able to make over the last 2 weeks, just in case if you missed the announcements in your region. I want to be able to bring those amazing changes and updates to you. Now, for those of you in BC, my name is Risha Baines. I am your Life Sales Director in BC. I'm supported by Michelle Kwan. On the living benefits side, we have Leah Kim and Albertson Tolentino. I'm sure you're already well familiar with us. For everybody else that is in different provinces, what we will do is we will attach a slide for all the sales directors in each individual province. So you know you have access to your sales directors on the life and the living benefits side. Now, one of the questions that was on the chat was, how do we get access to an individual in Venora's position in terms of advanced cases for those enhanced conversations? As Venora mentioned, please contact your regional sales directors. Once you contact us, we have a discussion on the case. We're able to involve the advanced case team and all the aspects that go along with that. Now, the conversation when it comes down to IA, big enough to matter, small enough to care, it is certainly something that we have taken on and really been able to catapult ourselves into listening to our advisors and really fitting the mold to change. Change is something that we absolutely love, we embrace, and on a year-by-year basis, and I even say for the last couple of weeks, a week-by-week basis, we are changing, we are enhancing, and we're launching brand new things. So what I want to do is really talk about the changes we've been able to make, and that really catapulted us into the #1 position, from whether you're talking about products, whether you're talking about platforms, and really, again, our standings in the industry right now. We have become that one-stop shop when it comes down to conversations that you're having with your clients, whether it's life, living benefits, or again, the saving side of things. I'm not going to spend a lot of time on this, but what I do want to get to is the major changes that we've been able to introduce that can enhance your conversations with your clients as an overall conversation and really positioning IA. When it came down to IA, one of the major changes that we made over 3.5 years ago was with our Par Whole Life. With the launch of Par Whole Life, we were able to enhance the conversation and really step into a field when it comes down to those affluent clients, those business owners, or individuals that are looking to either maximize their estate with our estate version, or again, take a look at wealth options with our wealth version. So you do have the best of both worlds with IA. You have our estate version, you have our wealth version based on the strategies that you're looking at for the client. Now, with all of that, one thing we wanted to do was add a bit of flexibility. Truly, the word flexibility is something that IA takes in pride of, whether it is the way our product works, whether it's in the conversations that you're having with your clients, whether it's structuring the product itself for your client. So with all the same payment information, same payment structures based on all the clients need, we wanted to really add that flexibility into our dividend options. So for those who are aware, for those who are not, and if you have not looked at IA in the previous day, one thing we've been able to do is incorporate flexibility when it comes down to our dividend options, meaning you can change the dividend options every policy anniversary year without any underwriting. And I'll kind of get to why and when that would be something that you go ahead and use. When it comes down to additional deposit option, I'll talk about our key feature that is stop and go. Again, how that works as a growth accelerator as well. Now, typically, many of you have those business owner clients, and you can agree with me when it comes down to the last couple of years, they have gone through quite a bit of change, whether based on the financial market, without changing of the environment, the ups and downs that a business owner experience, they are quite unpredictable. With the flexibility of being able to change your policy dividend options every policy anniversary, it kind of gives them that buffer around the whole life cycle of their business. If they're having a bad year, they can go from paid up additions to annual premium reduction and really, again, be able to not lapse on their plan, not be able to fully collapse the stage and that wealth planning or the estate planning that you as an advisor has put forward for them. And when they're back and they're stable on their feet, they can come back to their paid up additions and really be able to have that planning still in place. It really helps out the client in terms of sticking to the plan that you as an advisor have put in place, and really helps the advisor, again, to not have this policy completely lapse, not have that chargeback, truly that win-win situation for each client there is. Again, remembering You can change these dividend options every policy anniversary year without any underwriting required. Last but not least is, again, the additional deposit options. Many of you already on the call know what an additional option is. This is the additional savings model inside a PAR program that I really like to call that supercharger in your policy that helps catapult that plan itself. Now, when it came down to IA, we had a very unique feature when it came to IA. It's called our stop and go feature, meaning as long as the premiums have been contributed and underwritten for the additional deposit option, you were able to stop the additional deposit option contributions for as long as you like without any minimum or maximum, and start them up any time without any underwriting. Again, really adding that flexibility inside the overall plan. What we were able to do with that was even enhance it a lot more in terms of the changes that we've been able to introduce. So any new applications as of March 6th, we have, if the amount of the face value of the death benefit is $2 million or less, we will no longer require the need for a payment to secure the additional deposit option. So you can secure the additional deposit amount as long as your face value of the policy is $2 million or less without any actual payment. This will be based on the application and illustration. We will be able to underwrite based on that, and you will still have access to the stop and go feature. Really, again, you know, individuals like a small business owners that are just starting out that want to create that wealth down the road, but be able to have access to that additional deposit savings option and may not have the contributions be available right now. This is a great feature for us to really be able to customize and have that flexibility for that business owner. If you are looking at face amounts in those large policies that are $2 million or higher in terms of a face amount, when it comes down to the additional deposit of that face amount, we will require it. However, now we give you up to 2 years to deposit that additional deposit amount, and you still have access to that stop and go feature without any underwriting. Again, really giving those large case and those affluent business owners the flexibility and the time horizon to be able to have that deposit be available for them and be able to secure it based on their application and illustration. So again, we're wanting to put the flexibility back in the client's hand and be able to customize the illustration for them and be able to have that flexibility. Now, when it came down to the conversion side of things, one of the biggest, drivers of a lot of the continued guaranteed insurability conversations are term conversions. You know, if you've sat down with a client, you've had a small policy, a term policy be in place for them previously, and now you are converting that one base to really create that wealth option. You want to have flexibility. You want to be able to have options to really, again, have that seamless process. Now we're able to do that with our brand new conversion rules. And again, we will be sending a copy of this presentation to IDC to have it be uploaded, just in case I'm going through this a little bit faster in the interest of time. If your face amount is $2 million or less, you will have access to the additional deposit option without any additional underwriting. Now, this is an amazing feature where, again, you have that flexibility to add on this growth feature and this additional saving option. You will have up to 2 years to deposit the additional deposit amount and still have access to the stop and go feature without any additional underwriting. Now, all of these things have been made available based on the launch and the changes as of March 6th. So if you have not had a chance to previously look at IA, this is a great way to take a look at us, really, again, to enhance those conversations. Oh, sorry, everyone, a little bit of technology. Oh, there you go. Now, if there are face amounts that are $2 million or higher, if we're looking at those large cases, it will be the same rules as before, where the underwriting will be required if you're adding on the additional deposit option amount, but you will still have 2 years to deposit the ADO and still have access to the stop and go feature for underwriting purposes in terms of, again, having that stop and go feature and then being able to start and stop it without any underwriting. Sorry, I was trying to read and answer the questions at the same time. All right, now one of the questions that came up on the chat box was regarding our PAR dividend Great. And then I wanted to really just be able to reference that. Many of you may not know, IA is actually part of the top 15 investment firms in Canada. We actually have over $100 billion of assets under management. The individuals that really take a look at and manage our PAR fund are the exact same individuals that manage our general fund. So we've been able to really have that conversation around longevity and being able to have the experience of managing a large fund. We've been able to bring that over to our PAR fund and have that long-term return and objective be met every year. Since inception of our PAR fund, we started it out at 5.75, and we have gradually and consistently been increasing our dividend rate. And again, relaunching our dividend at 6.25 for 2024. Our discipline and diversified approach really comes from the individuals that manage our PAR fund and been able to really be committed to this return. Now, we do have a secret to a success, and that really comes in the form of alternative assets. If you talk to a PAR fund manager, and I did a great presentation with our PAR fund manager, Mr. Dominic Siciliano, a couple of weeks ago. For those of you who may have joined me on that one, you were able to hear him talk about the focus on alternative assets and really the return that has been able to derive from that. That has been really been able to capitalize on that based on that disciplined approach. We are not day traders, as he likes to call it. We like to take a look at the long-term horizons. We like to have this as a key differentiator versus our peers and really be able to attribute to this for our strong returns. We are going strong and we're keeping strong. And if you would like to know more about our PAR fund, I will be able to send some information on that after the call as well too, as a quick follow-up in terms of the breakdown of our PAR fund and really, again, the details that follow up on that one. I know I'm at the end of my time, but a little bit of a last bit of a quick launch conversation. In 2024, we did launch our IA Premier program. I won't spend a lot of time on this, but I do want to talk about the fact that we've taken two of our bonus programs, which were our CPB, our continued production bonus, which is just 10,000 net FYC, and our business development bonus that incorporates our large volume of advisors in large volume of business, as well as our investment advisors. And we were able to combine it underneath one umbrella and be able to really cater to our advisors that fall into each one of these categories. We've been able to launch amazing kind of additional incentives for those elite advisors and be able to really have specialized gifts and specialized marketing options be available to them. If you have not taken a look at IA previously, I'm hoping with the conversation that where Vanara was able to talk about life insurance as an asset class and really how to position it well for your business and your clients. And where IA truly shines in that is something that has been able to catch your eye, especially against some of the changes that I've been able to talk about when it came to IA with regards to our additional deposit options in the last 2 weeks. And again, when it comes down to being rewarded for the excellent work that you already do, IA always believes in supporting our loyal advisors, and we want to be able to give back for the incredible work that you do. Now, I will encourage everybody to connect with their local IA sales directors, and anything and everything that you saw in terms of that interests you, please reach out to them. They will be able to give you more information on that. I know there are a few questions in here. In terms of our DSIR, that is our PAR dividend return. That is 6.25 currently right now. I do realize again that we want to be able to give more information on that. We have launched new communication and new marketing materials on this, and we will be sending that out to our advisors. You will see brand new information be launched on this very recently as well too. And again, you will see a lot more marketing information coming in the months to come on this information. I think we have another question in terms of information on our policy values. Is there change being made regarding policy values? Yes, we are. We are doing a change in terms of all of our policy values, sales structure summaries, as well as our marketing material. As I mentioned, we have gone through quite a bit of a change as a carrier in terms of launching brand new products, launching a new platform, and taking a look at changing the way we do business and the way we market ourselves. So you saw quite a bit of that change in terms of our advanced case teams. You're going to see a lot of that change based on our software as well as a new launch that we're looking at in the next upcoming months. We are doing quite a bit to change when it comes down to our overall processes and admin as well too. So there's been a few hurdles in terms of some admin side of things. However, again, as I mentioned, as we grow and we're listening to our advisors, we're doing the back end changes of that as well too. So you will see quite a bit of new information coming out in 2024. And as the launch and the change of our additional deposit option, the launch of our IA Premier program, these are just testaments to the changes that we've been able to do. So that is it for myself. If you do have any questions, please feel free to contact your local IA director in your region. If you are in BC, that is myself and Michelle. We will be able to assist you in any and all questions in terms of putting a plan together, putting the right plan together, and being able to really talk about more about the changes. I apologize for the rush at the end, guys. I know I have to stick to a quick time, so I had to talk a little bit fast, but we will be able to send out more information on this. And if there are more questions, we'll be happy to assist and be able to provide the right contact information for your local sales directors as well.
Thank you so much, Rishu. Thank you all for joining us today. As Rishu said, you know, if you're not sure who your partner is at Industrial Alliance, please feel free to reach out to us as your business development executives. Part of our role is to maintain these relationships with our carriers, so we'd be more than happy to make sure that you're connected with the appropriate individual across the country. So thank you again. I hope you all found this informative. As we mentioned, this presentation and the slides will be available on the IDC WIN Big website in the next couple of weeks. I would like to make a quick plug for the IDC Spring University Days. So you should have received an email invitation last week. We are hosting it across the country throughout the month of April. So please do look out for that invitation. And if you haven't received it, please feel free to reach out to your business development executive or hit up the IDC website and there'll be links to register. So it's always a great opportunity to connect with your wholesalers, to meet with fellow advisors and network. So we look forward to seeing you all at the Spring University Days, and have a great rest of your day. Take care.
Thank you. Bye.